After studying this module, you shall be able to understand the three different approaches to measuring the national income, reason why the three approaches must arrive at the same amount of national income, identify the need to measure real GDP, know the difference between real and nominal GDP, and finally learn how to measure several other important aggregates, price indices, as well as inflation.
This module helps us in understanding how the national income is measured, what are the different types of approaches to measuring the same, and let us now therefore start. National income accounting is a system which helps the government of any economy to measure its national income or the country's level of economic activity. National income helps in keeping track about the economy's health and also in forecasting its future prospects. National income accounting also helps the economists and statisticians to know how well the economy is functioning and what are its income and expenditures. However, I am sure you understand it can be very tricky process also. Therefore, we need to be very clear about what is to be included and what is not to be included while calculating the national income of an economy. And will purchasing a house be classified as a consumption or an investment? And when the citizens earn money abroad, is it included in the national income of a country or not? All these are the questions which we have to answer and understand. And you will realize that there are also many more which may come to your mind and which we would like to answer wherever possible. Let us now try to answer all these questions in this module and begin with by explaining the different type of approaches which are used in the measurement of national income. The circular flow of income basically explains that there are two sides of any transaction, which is the income side and the expenditure side. Therefore, any transaction could be measured through income or the expenditure approach. However, any transaction which adds any value to the economy involves three elements, not just two. These elements are the expenditure incurred by the customer to buy the product, the income received by the seller, and third, the value of the product which is being sold. Now, this can be easily explained by a simple example. Let us say that an individual like any one of you buys a pen for ₹10 from a shopkeeper. Now, in this case, the expenditure of an individual like any one of us is ₹10. The income of the shopkeeper is ₹10 and the value of the product is also ₹10. Now, all the transactions occurring in this case in the economy can be looked in the same way, and this provides us with three approaches to measuring national income: the income approach, the expenditure approach, and the value added approach. Now, these are explained in detail so that you are comfortable after learning from this module about these three concepts. We would also discuss about other aggregates in the economy apart from GDP, which could be your personal disposable income, savings, which are both private as well as government, national wealth, national foreign assets, and current account balance. I am sure you are familiar, or some of you are at least familiar with some of these concepts. However, it is very difficult to combine the information on various goods and services which are being produced in an economy into one single term or measure of GDP, or just one value of GDP. But for this purpose, the economists need to study the level of prices in the economy, which means basically that the price level and the rate of change of price level over time, which is known as the inflation rate. Because it is through this price that all the products are added together to bring to a one single figure or one single value. In this module, we will also discuss the various price indices and the method to measure inflation in any economy. The module will be helpful in learning about the various measures of national income accounting as well as various aggregates which are used in the economy. It will also shed light on the national income accounting in India and its estimation. Now let us therefore move on to the study of national income accounting.
We already know the concept and coverage of the national income or GDP and the importance of measuring it. This module helps in explaining how we can measure the national income. The circular flow of income suggests that every transaction has two sides, the income or the output side or the expenditure side. Accordingly, GDP can be measured from any of these approaches, the income approach or the expenditure approach. Apart from these two aspects of transaction, there is one more aspect which focuses on the value added to the product. This forms the third approach, the value added approach. Now, let us look at these approaches in detail. The first method we will discuss is the value added method. In this method, value added of each production unit is added together to arrive at the total value of production. We know that every economy is classified into few broad sectors like agriculture and allied activities, manufacturing, electricity, gas, water supply, construction, and services like trade, hotels, transport and communication, insurance, and other business services. The value added in each sector is summed to arrive at the GDP figures. Now, the second method of estimating GDP is expenditure method. According to this method, GDP is computed as the sum of consumption expenditure, investment, government purchases of goods and services, and net exports. This can be expressed in the form of the equation GDP is equal to C plus I plus G plus X minus M. Let us now understand the components of this equation. Consumption expenditure is consumers spending on durable as well as non-durable consumption goods and also services like health, transport, education, etc., both on domestic as well as foreign produce. Next is the investment expenditure. Investment includes addition or accumulation of physical capital such as new buildings, business plans, machinery, as well as change in inventories. In case of inventory investment, additions to the stock of inventory are included in the GDP as it is a part of the current production. Investment is therefore something that adds to the productive capacity of the economy. In this sense, investment in human resources can be considered a part of investment expenditure. Another example is that of residential spending on housing, which is a part of total investment as it continues to serve households for a large number of years. Finally, the investment listed here in the equation is the gross investment, that is, without deducting the depreciation. To compute net investment, we would deduct depreciation. The third part is the government expenditure, which includes purchases of goods and services, both domestic and foreign by the government, such as defense expenditure, salaries of the government employees, etc. Lastly, net exports or the trade balance is the exports minus imports. Exports are currently produced goods that are purchased by the foreigners. Imports are the purchases of foreign goods made by domestic buyers and should not be counted in GDP. However, imports are included in C, I, and G. Therefore, imports are subtracted to compute the GDP. Both these methods, expenditure and value added, look at the production side of the GDP. One could also look at GDP from the incomes earned by the different factors of production. This leads to the third method of calculating GDP, which is the income method. GDP is the sum of all factor earnings made from the current production of goods and services, including profits earned by the producers and taxes paid to the government. Through the income method, GDP is computed as the sum of compensation of employees, corporate profits, proprietors' income, rental income of household, current surplus of government sector, and net interest. Compensation of employees is the income of workers but excludes the self-employed income, consisting of wages, salaries, other employee benefits, and employers' contribution to the pension schemes and other social security schemes. Corporate profits are the residual incomes earned by corporations after making payment of wages, interest, rents, and other costs. These corporate profits are then utilized for tax, dividend payments, and finally kept as retained earnings. The proprietor's income is the earnings of the unincorporated self-employed. The rental income includes income earned by the landowners, royalty income by authors or artists. Let us now try to understand these three methods by working through an example. This example will demonstrate how the three methods would arrive at the same value of national income. Suppose in an economy there are two firms, Tomato Limited and Ketchup Limited. Tomato Limited produces tomatoes and sells it directly to the consumers as well as to the Ketchup Limited. The Ketchup Limited sells its output to final consumers only. The table provides an account of transactions of these firms. Now let us go through each approach one by one. Value added approach. According to this approach, the national income in the economy is the sum of value created in the two firms. If we add the receipts from the sale of final output of both the firms, that is rupees 35,000 plus 40,000, the national income will be 75,000. However, this involves adding the value of tomatoes twice, resulting in double counting. To avoid this, we should add the value added in each stage or by each firm. The value added by the Tomato Limited is 35,000, assuming it does not use any intermediate inputs. Now the value added by Ketchup Limited is value of final output minus cost of intermediate inputs, that is 40,000 minus 25,000. This will be 15,000. Accordingly, the national income in such a hypothetical economy is national income is equal to value created by Tomato Limited plus value created by Ketchup Limited equals 35,000 rupees plus 15,000 rupees, which will be equal to 50,000 rupees. Expenditure approach. According to this approach, national income is the sum of final expenditures incurred in the domestic territory. In the above example, the household spent 10,000 on tomatoes from the Tomatoes Limited and 40,000 on final product from the Ketchup Limited. Therefore, national income by expenditure method is 50,000. Income approach. This approach sums the income received by all factors of production. In this example, the profits of Tomato Limited are its revenue generated minus wages, that is 20,000, and profits of Ketchup Limited are the revenue minus intermediate inputs and wages, that is 5,000. The wage income of the economy is 25,000, 15,000, and 10,000 of Tomato Limited and Ketchup Limited respectively. The national income will be equal to wage income plus profits income, that is 25,000 plus 25,000, which is equal to rupees 50,000. Thus we can see that the amount of national income derived through different approaches is identical. The reason is that whatever is produced in the economy, an equivalent amount of income is generated and an equivalent amount of expenditure takes place. Now that we have understood national income estimation using different methods, let us look at certain other important aggregates frequently used in macroeconomics. Personal income is the measure of total income received by households from all the sources. If personal income tax payments are deducted from the personal income, we get personal disposable income, which is the income available to spend for the private sector. That is, personal income is equal to national income minus corporate profit tax payments minus undistributed profits minus contribution to social security plus the transfer payments to the households plus the personal interest income. The personal disposable income is equal to personal income minus personal taxes. Further, the part of income not available for private sector is the government's income. The government income is equal to taxes minus transfers minus interest payments on the government debt. Apart from the current income, households' wealth is an important indicator of its standard of living. Wealth may be defined as the value of its assets less the value of its liabilities. Similar to an individual, the wealth of a nation, termed as the national wealth, is the difference between what the nation owns, its assets, minus what it owes, that is, its liabilities. The rate at which the national wealth increases depends upon the rate of savings in an economy. Higher the savings, higher will be the rate of wealth accumulation. There are two main sources of savings: private sector and government sector. Computation of private sector saving is based on the logic that whatever is not consumed is saved for the future. Therefore, private saving is equal to the private disposable income minus the consumption. That is, private sector savings is equal to private disposable income minus consumption, which is equal to GDP plus net factor income from abroad minus taxes plus transfers plus interest payments minus the consumption expenditure. It can be written as GDP plus NFY minus T plus TR minus C. The government saving, on the other hand, or the budget surplus, is measured as the net government income minus the government purchases of goods and services. That is, government savings is equal to government income minus government expenditure. That is, taxes minus transfer payments minus interest payments minus the government expenditure. It can be written as T minus TR minus INT minus G. As stated above, the national savings are the sum of government and private savings. Therefore, the national savings can be written as private savings plus government savings. That is GDP plus NFY minus C minus G. This equation illustrates that the savings in a nation are equal to the total national income, both domestic and net foreign income from abroad, minus spending by the consumers and the government. The private savings can be put to a number of uses, such as investment, lending to the government, and foreigners. To understand the uses of private spending, let us substitute the income expenditure identity, that is, y is equal to c plus I plus g plus nx, in the national savings equation. This gives us national savings is equal to c plus I plus g plus nx plus nfy minus c minus g, that is I plus nx plus nfy. The terms in the brackets in the above equation is the current account balance, which is the sum of net exports and net factor income from abroad. So we can say that national savings is equal to investment plus current account balance. Now subtracting government savings from both sides of this equation, we get national savings minus savings of the government is equal to investment minus government savings plus current account balance. Therefore, the private savings can be written as I minus government savings plus CA. This equation shows us the uses of the savings identity. This identity suggests that the savings in an economy can be used in three ways. First is the investment, second, for financing the government deficit, and third, for supporting the current account balance. The next aggregates we will discuss are the net foreign assets and the current account balance. Net foreign assets, or NFA, is defined as the value of assets held by a country abroad minus the value of domestic assets held by the foreigners. The current account balance is equal to the change in net foreign assets. Moving on, let us study another aspect of the term gross national product, or GNP. It is the sum of gross domestic product, GDP, and the net factor income from abroad. This yields the following equation: gross national product is equal to GDP plus net factor income from abroad. Substituting the income expenditure identity in place of GDP, we get GNP is equal to C plus I plus G plus NX plus NFI, and GNP is equal to C plus I plus G plus CA, where CA is the current account balance. This provides another interpretation of the GNP in terms of domestic spending for the consumption expenditure, investment expenditure, and government, referred to as absorption, and current account balance. If we take the absorption term to the left hand side, an important interpretation can be derived. For a country where GNP is less than absorption, the current account will be in situation of deficit. We have been discussing about the term GDP a lot, but we should know the difference between the nominal and the real GDP. The nominal GDP, or the GDP at current prices, is defined as the value of total production of goods at their current prices. In this case, the GDP would increase either due to the increase in quantities or prices or both. But improvement in the living standards depends on the increase in quantities rather than the prices. In order to eliminate the effect of price changes, we estimate the real GDP. To arrive at the real GDP figure, that is the GDP at the constant price or GDP adjusted for inflation, the production of final goods is valued at some constant price or the base year. Let us understand this concept using an example. Suppose the economy produces two goods, computers and printers. The prices in year 1 are rupees 30,000 and rupees 5,000 for computers and printers respectively. We assume year 1 is the base year. In year 1, the economy produces 10 computers and 5 printers. Therefore, the GDP in year 1 will be equal to 30,000 multiplied by 10 plus 5,000 multiplied by 5, which is equal to 3 lakh plus 25,000 equal to 3 lakh 25,000. In year 2, the production of computers and printers doubles to 20 and 10 respectively. The prices have also increased to 32,000 and 6,000 respectively. Therefore, the GDP in year 2 will be equal to 32,000 multiplied by 20 plus 6,000 multiplied by 10, which will be equal to 6,40,000 plus 60,000, that is 70,000 rupees. Therefore, we can see that the GDP has increased from 3,25,000 to 7 lakh. However, not all of this can be attributed to the increase in quantities of computers and printers. To estimate the increase in physical production from year 1 to year 2, we compute the real GDP in year 2 at year 1's price. Therefore, the real GDP in year 2 will be equal to 32,000 multiplied by 10 plus 6,000 multiplied by 5, which is equal to 3,20,000 plus 30,000, that is 3,50,000 rupees. The percentage growth of real GDP can be calculated as 3,50,000 minus 3,25,000 divided by 3,25,000, which is equal to 7.69%. Thus, the real GDP is almost 8% higher in year 2 than in the year 1. In an economy where nominal GDP increases at a rate faster than the real GDP, the prices must be rising. To measure this rise in prices or inflation, GDP deflator, written as PT, is computed. GDP deflator is equal to nominal GDP divided by real GDP. In the base year, real GDP equals nominal GDP, and hence price level or GDP deflator is equal to 1. The rate of change in GDP deflator is calculated as PT minus PT minus 1 divided by PT minus 1. This is used to measure the general level of price rise over time, that is, the rate of inflation. Let us now understand how the GDP deflator is computed with the help of an example. This table gives an example of price of bread in the years 2010 to 2012. Suppose we have to compute the price index in each year using the base year prices of 2010. In the base year, the bread was sold at rupees 16. This increased to rupees 18 in 2011 and further to rupees 20 in 2012. The price index is calculated by dividing the current year price by the base year price multiplied by 100. In the base year, the price index will be 100. In fact, the price index in the base year is always 100. The index rises to 112.5 in the year 2011, indicating that the prices are 12.5% higher in 2011 as compared to 2010. Further, it rises to 125 in the year 2012, indicating that the prices increase by 25% in 2012 over the base year 2010. The computation of price index enables a quick and easy comparison of the price change with the base year. Now, we all know that the GDP deflator is based on the final goods and services produced in an economy. However, to the consumers, it may be of interest to see the rise in prices of the goods they consume as they directly affect their cost of living. This information is provided by the consumer indexes such as Consumer Price Index (CPI) and the Wholesale Price Index (WPI). There are a number of differences between CPI and GDP deflator. The CPI measures the retail prices of a fixed basket of goods and services consumed by the households, while the GDP deflator is based on the prices of a wider group of goods. Secondly, the GDP deflator is based on actual production of a product in the economy. The basket changes from year to year, while the CPI is based on a fixed basket of goods. Thirdly, the CPI includes all goods, domestic as well as imports, that are consumed by the households, while the deflator includes only the domestically produced goods. Most government payments, such as pensions, social security benefits, and dearness allowances, are based on CPI. WPI, on the other hand, measures the wholesale price of large number of items. There are a number of problems with these price indices. The quality of products has been continuously improving over time, which results in their price rise. However, CPI does not account for any such improvement in quality of products over time. CPI is expected to overestimate inflation because it is computed over a fixed basket of goods and services consumed by a typical consumer, and not all products in this basket will experience the same percentage change over time. India has a well developed system of measuring national income accounts. The national income in India is estimated by the Central Statistical Organization (CSO). It classifies economic activities into: first, primary sector consisting of agriculture, animal husbandry, forestry, fishing, mining, etc. Second, secondary sector consisting of manufacturing, electricity, gas and water supply, construction, etc. And tertiary sector consisting of trade, hotels, transport, communication, finance, personal services, etc. The CSO provides estimates of GDP quarterly at both current as well as constant prices.
Students, national income accounting is a fundamental statistic in the macroeconomic analysis, and it is considered to be one of the most far-reaching innovations in the field of applied economics in the 20th century. This process helps in providing a quantitative basis for evaluating the government policies also. It is especially important in the emerging economies, as an accurate and dependable national income accounting system is a crucial step in its path of development. Now, this module was created with the aim of explaining not only the concept of national income accounting, but most importantly, for understanding the various measures used for calculating the national income. All the measures results in identical results, as they are nothing but different ways of looking at the same transactions. I'm sure you must have noticed all this. And we have studied these measures in detail along with the different aggregates which are used in an economy, like, as we said earlier, the personal disposable income, private and government savings, national wealth, etc. We have also learned something and some basic facts about some of the price indices which are used, like wholesale price index and other different types of consumer price indices, and I'm sure you have also therefore seen their limitations also. This is an important component in estimating the national income along with the level of inflation prevailing in an economy. India's national income estimation policies are also studied in brief to understand how national income is actually measured and studied in our country. I am sure through this module we have learned that it is very important to compute the real GDP of any country in order to compare the performance of our economy over time and, if necessary, our economy with other economies of the world. However, in reality, the statisticians face a number of problems and complications while estimating the national income and other aggregates. The major reason behind these problems is that although there is a vast array of information available for calculating national income, like the tax return details, value-added figures, expenditure and income reports, however, it is sometimes not accurate or simply incomplete in many cases. Since many different and varied techniques and valuation methods are used for estimation, I am sure you would appreciate that there is a high probability for an error to occur, even though a margin of error always accompanies the published reports. National income accounting is considered to be, therefore, an inexact science, but it is one of the most useful tools for economists and statisticians for budget planning. Thank you.
Let us now summarize what we have learned in this module. We studied about the three approaches to measuring national income: value added method, income method, and expenditure method. All the three methods result in identical results as they are different ways of looking at the same transactions. We learned that personal income is the measure of total income received by the households from all the sources. If personal tax payments are deducted from personal income, we get personal disposable income, which is the income available to spend for private sector. We also studied about the three uses of private savings: investment, financing government deficit, and supporting current account balance. In order to compare performance of an economy over time, it is important to compute real GDP. And lastly, we learned that India has a well developed system of measuring national income, and the task of measuring it is entrusted with the Central Statistical Organization.